In today's presentation, I wanted to specifically talk about some of the things you as realtors can deduct, some of the strategies there are from a tax perspective, and at the end we're going to have a Q&A, so if you have specific questions, I'd love to help answer those as well. All right, so these are going to be the three topics from the presentation. So part one, I wanted to talk about some of the deductions for self-employed realtors. So I'm going to focus on things that we notice people forgetting or not adding on their tax returns. So as realtors, I'm assuming a majority of you are receiving a 1099 and are self-employed. And so we want to talk about the deductions that we want to make sure everyone's taking advantage of, because obviously we want you to be paying as little amount of tax as possible. In part two, I'm going to talk about creating an LLC. Should you elect S Corp tax status? Talk about the pros and cons there and why it might make sense to do so. And then in part three, I wanted to dive into the real estate professional tax status for investments. And we're going to talk about how you can offset income with losses in real estate. So part one will be the deductions for self-employed realtors. And on the next slide, I have some of the common deductions. Some of these I'm just going to quickly go over, but I want to spend more time on others. So, if you're receiving a 1099, if you're self-employed, by default, you're getting this 1099 in January or February, and let's say the top line box one is $50,000. If I was an employee and I made $50,000 in compensation, my employer is withholding, that Social Security and Medicare tax and also some federal income tax. So if you've ever been an employee before, you know that maybe you get paid $1,000, but you're only receiving $700 or $800. You're getting a net amount, and that's because you're withholding federal tax. You're also withholding Social Security and Medicare, and your employer is matching, so they're paying the other half of your Social Security and Medicare. So that adds up to 15.3%. When you're self-employed and you get a 1099, you're on the hook for all 15.3% of that. So if you just get a 1099 for $50,000, you put that on your tax return with no deductions, you're going to get charged 15.3% on $50,000, which obviously is a big number. And then in addition to that, you're going to have your federal income tax. So you're really paying three taxes: Social Security, Medicare, and the federal income tax. So that's why deductions are going to be super important, obviously. So we always want to go over your deductions here. Make sure if you're getting a 1099, you're writing off things like advertising, your supplies, dues and subscriptions if you're paying for Adobe or QuickBooks or some type of subscription service, realtor subscription service, bank charges, credit card fees. A big one is auto expenses. I wanted to touch on this. We can either take the standard mileage deduction, which now is 70 cents per business mile. So that's going to be great if you have a less expensive vehicle, you drive a lot of miles. Then what we're going to do is we're just going to say, hey, I drove 10,000 miles in 2025 for my realtor business, and that's a $7,000 deduction. We take the 10,000 business miles multiplied by 70 cents, and that's your deduction for the year. But maybe you have a really expensive truck, it's 100% business use, and you don't drive quite as much each year. Then it might make sense to take the actual method, and that's where you're taking depreciation on the cost of the vehicle. You're writing off the actual fuel expenses, repair and maintenance, oil changes. Even if the vehicle is only 80% business use or 60% business use, we can allocate that actual cost based on the percentage as well. So we always want to look at it both ways, but once you pick mileage, we need to stick with mileage. We don't want to flip back and forth year to year. So per vehicle, we want to stick with the method we select. So just something to mention. Other things people don't always think about would be like go ahead. Sure. Yeah.
So within the depreciation, how is that calculated based on mileage of business use?
So yes, if we're taking the actual method, we would say, what is my business usage of this vehicle? Maybe it's 100%, in which case we could depreciate all of it. But if it's not, the way to determine the business percentage is by mileage still. So you kind of want to keep up with mileage regardless. But if we're taking actual method, we would say, okay, I drove 7,000 miles for business. but I drove 10,000 total miles this year. So that's 70% of the depreciation. So yeah, you take 70% of your, and so in other words, you keep up with all of your fuel receipts for the whole year, and we'd multiply that by 0.7 and take 70% of your fuel, 70% of depreciation, 70% of insurance, 70% of oil changes, tires, repairs. So yeah, that's how we would do it.
I put my rules for advertising all over my car. Do I get to write off my car more because it's advertising, or just the cost of putting the wrap on?
Yeah, it would just be the cost of the wrap, because even though it's always on the car, you might still be using the car personally. So we would write off. It is advertising, that's true, but technically we're supposed
So if
to.
Janet here pays me to put her advertising on my car, then I could charge her amount of advertising costs, and she could write all that off.
That's true, but then you would want to include that in income on your taxes. But yeah, that is true.
Which, okay. I just wondered how that works, because you see that, they just put information on the vehicles. It's not as advantageous if all they can write off is the cost of doing that, so.
Right. Yeah, so we always tell people, if you have a less expensive car and you're driving all over the place, right? Mileage is oftentimes the better way to go. It's also a lot easier. And when you sell the car later, there's no depreciation recapture. If you take the actual method, so this is an important thing. If you take the actual method, and let's say we say it's 100% business use, and I paid $50,000 for this car, I depreciated all of it. Another caveat, we can accelerate the depreciation, so we can take all of that in the first year as opposed to spreading it out over a few years. But let's say we fully depreciated it, now we're going to trade it in for a new business vehicle. Well, unfortunately, because we've depreciated it and taken that deduction, we have to recapture that as income in the year we trade it in. So that's another reason why taking the actual expenses could be viewed as a negative, because later down the road, when you trade it in, you're going to get to write off the new business vehicle, but you're going to have the recapture of the trade-in. So you're only deducting a net value. So that's just something else to mention.
So here's on that. Whatever they give you for a trade-in value, you have to count that. If they're giving you $10,000, that's $10,000 in income, correct?
Yes. So if we wrote off a vehicle for 50, for example, in 2024, but then 3 years later we trade it in for 20,000 and we get a new vehicle for 50,000. So on the new vehicle, we can write off that 50,000. But we're going to have a depreciation recapture of that trade-in of 20,000, and so that's going to basically be income on the tax return. But we're going to have the new vehicle depreciation, so you're getting a net deduction still, but it's not. I guess that would be the negative of the actual method, because if you only do mileage, when you trade it in, you move on to the next vehicle.
You're going to get into the LLC side of the car buying, correct?
Yes, we'll talk about LLC here in just a minute. Any other questions on auto?
Because we were talking about accelerate depreciation and take it all the first year. That's under the ways of
That's what it is.
Well, you are right in that even a sole proprietor, like even if you don't have an LLC, you can, and that's something we're getting ahead of ourselves, but in the next topic, I'm going to talk about this. But even if you don't have an LLC, you don't have a DBA, you're just a sole proprietor who gets a 1099, you can still deduct all of these expenses if they're applicable to the 1099 income you received. So with the vehicle, if you have a vehicle that's above 50% business use and you take the actual method, if the gross weight is the 6,000 pounds or more, we can accelerate and do the Section 179 depreciation where we write it all off in the first year, as opposed to spreading that out over 5 years. If it's under 6,000 pounds, we can still accelerate some of it, but not necessarily 100%. So you were on the right track. Okay, so the other things, internet, telephone, we see a lot that people, they're doing a good job keeping up with their business expenses, but they have a cell phone and they have an internet bill at home and it's kind of intertwined with personal, so they don't think to add this. Technically, we're supposed to allocate it similar to the vehicle where we'd say, okay, it's 50% business use, it's 80% business use, and we would take a percentage of the internet and cell phone. However, we've seen that, or really, you can take 100% of these because that can having a cell phone or having this internet at home is the main purpose of that is your livelihood, is your business. So instead of adding these as part of the home office deduction, which we're about to talk about, you can take these at 100%, or you can be conservative and take 80%, or kind of allocate it based on phone logs and how long, how often you're on the phone for business versus personal, and so on and so forth. Meals, that's another big one. When you go out to eat, if it has a business purpose, we can take 50% of your meals. So a lot of times what we would suggest is if you do create an LLC, you can put your children, your spouse on your board, and then every time you go out to dinner with your spouse, if you can have a board meeting, incorporate some business conversation, and just keep track that it's actually a business meal, you can deduct 50% of that meal. Yes.
So for a while there, it was 100% during the COVID thing. Is that now?
Yeah, during COVID, they upped it to 100% for 2 years to help the restaurant industry, or just to give that. I think it was 21 and 22. It was just like a 2-year period, but that's back to 50%, unfortunately. Travel, that's another one. If you take a trip, even if it's a vacation, if part of that vacation is business related, then we can write off 100% of the airfare. And we can write off the hotel days that are business related. So if you and your family go out on a vacation, but maybe there's a conference there during that time that you go to, or you're there to meet with a potential client or view rental properties, then we can potentially write off 100% of the travel costs or the airfare costs, and then 100% of the hotel costs for the days that were business related. And then the personal days, we wouldn't be able to write those off as a travel expense. But that goes for meals as well, the meals that are business related, so on. So travel can be a great one. Another reason, which we'll dive into on why it's a great idea to potentially add family members to your LLC board of directors. Home office deduction. This you may be familiar with. This is where we can allocate by square footage. So, if you have a dedicated office space at your home, we could say, hey, I've got a 100 square foot room here. That's my home office. And my entire house is 2,000 square feet. So we would take 100 square feet divided by the 2,000, which is 5%. And then we can take 5% of all your annual home costs, such as mortgage interest, property taxes, all your utilities, electric, water, your homeowner's insurance. We can even take 5% of depreciation on your home. So you can get a few $1,000 deduction for your home office deduction each year. So this is a great one. If you don't want to keep up with all those numbers, you can also do the simplified method, which is just $5 a square foot. So if you have a 100 square foot home office space, you would just multiply that by $5, and then that would give you like a $500 deduction. But usually it's worth it to come up with those actual costs, because it's going to be a lot more than the simplified method. Okay, this last one is super important, we like to mention. If you have children under the age of 18 and they can somehow work for your business, whether that be modeling, if they're 2 years old, they can potentially do modeling, photos for the website. If they're older, maybe they can help clean up houses before you do a showing. Any way you can find actual work for them to do, you can pay them as though they were like an employee. But the benefit is you get to deduct that, and they don't have to pay a dime in taxes as long as it's less than the annual standard deduction, which is $15,000 per person. So if I have a 12-year-old and I need some extra help, we're showing houses and there's a little bit of like organization and things we have to do. My 12-year-old can come help me for 2 hours. I can pay her a reasonable salary, so maybe $30 or whatever that would look like. But then I get to deduct that, and at the end of the year, maybe I've paid her in total $10,000. That's a write-off for me, so I'm saving tax on $10,000. And as long as she hasn't earned more than $15,000, she doesn't need to file a tax return. I don't need to pay She doesn't need to pay a dime of taxes. And because she's under the age of 18, there's not even Social Security and Medicare tax. If they're above the age of 18, then you'd have to actually run payroll. They would have to withhold that 15.3% we talked about. But when they're your own children being paid through your own business, then that's a great way. We always, we want to say, don't pay taxes and then give your children money. Let your children work for your business. Gain that great responsibility throughout their youth, and then they can save for college or use it for sports or whatever it may be, and you're getting a deduction. So that's tax-free money. So that's a really good one. Any questions on
Over 18 for adult children?
I mean, you can still pay them. The benefit would be you're potentially shifting income into a lower tax bracket, so if you guys have a lot of income, you get all the way up to the 35% tax bracket, but your kid is 20 in college, you could pay that child $20,000. So you're saving 35% on $20,000, but then they're paying taxes maybe at 12%, so you're still shifting the money into a lower tax bracket, but they would technically have to pay that Social Security and Medicare and file a tax return at that point. So in other words, they would owe some tax, but it would still likely be a lot less than what you might owe if you hadn't done that. So,
But only your personal children, correct?
Yes, that's correct. It's a specific.
Right off your kids.
What kind of documentation, like what kind of proof?
Yeah, that's a great question. So the two big things, or really the three big things, we want to have some type of employment contract. So really just something on paper. It doesn't have to, it can literally just be something you've typed up on paper and have them sign. These are your duties. We're going to pay you X amount per hour. So you just want to have some type of paper trail of this is what we decided. And then it needs to be reasonable. So we don't want you to pay your kid $10,000 because they helped you one day. It needs to be a reason. What would you actually have to pay an employee to do these tasks? Yeah, you'd want to keep up with their hours. Exactly. You'd want to keep up with their hours or the tasks that they're doing and kind of come up with a reasonable cost that it would cost you to pay someone else to do it. Oh, nice. Yeah. Oh, the third thing, though, we want to have a bank account for them. So it is good to actually transfer the money to a bank account for them. And yes, go ahead.
So in regards to that, would as far as you have let's say you have the employment contract with them, and then you have an automatic, they help you continuously, like it's an automatic, these are the things you do, and if you don't do those, you don't get paid. But if it was an automatic withdrawal from my account to their account in a certain sum once a week or once a month, would that stand as proof as employment into their account?
Well, yeah, you want the money to move. So that's one thing. You want the money to transfer to their bank account. But two, you want to have something like I was saying on paper, like we've agreed that you're doing this, this, and this, and getting paid X amount per week or X amount per job. And we would just want it to be reasonable.
So it wouldn't be, I wouldn't have to receipt necessarily every time they did something, but if I had an employment contract, it said, you are doing da-da-da-da-da-da
Yes.
for this amount. Gotcha.
Yeah, exactly. So, yeah, it's a great deduction. One last caveat I'll throw in there is technically they're an employee when you do this. So normally you would have to file a W-2 for them, but you don't have to because as long as you're paying them less than the $15,000, they don't owe Social Security and Medicare tax, and there's no penalty for not filing a W-2. So anyway, I just wanted to mention that they're technically an employee, but you don't have to worry about W-2s, 940s, any of that stuff.
And what if they aren't old enough to have a checking account? Like if you said we use a smaller child for model painter.
Yeah, you can create you can still create an account for them, but it's like under you. It's I can't remember the name of it, but the bank.
At the bank, you can create you're the custodian of their account, and so they can have it, but you have access to it.
Okay.
Yeah.
Okay.
Cool.
Where do you represent that on your taxes?
Usually, you would either deduct it under the wages column or outside services is fine too. Yeah. So, like on the schedule, if you're filing a Schedule C, or if you're filing, so this is important actually. This is applicable for LLCs or like if you're a disregarded entity, which we're about to talk about. But if you're an S Corp, it doesn't work this way because the S Corp is viewed as a separate entity from you. So that is one caveat I should mention. This works for. Does everyone know what a Schedule C is? Do you guys know how you file? So if you're doing a Schedule C, or if you have another business where you're doing like a rental property and you have anything on your personal tax return, the farm schedule, the rental schedules, you can pay your kids this way and deduct it. But if you're an S Corp or a C Corp, unfortunately it doesn't work, and they would have to pay the Social Security and Medicare. You could still do this. You could still pay them up to the $15K. They won't have to file a tax return, but if you have an S Corp, you'll want to put them on payroll, and you'll basically be paying that 15%. But it's still good because you're potentially shifting money to a lower tax bracket, and again, instead of paying tax and giving them an allowance or paying for their college, you're kind of letting them earn it themselves. So I know this is a lot. Any other questions specific to some of these deductions we've gone over? Okay, I'll talk, and obviously this is not everything. These are just some of the more common ones that I was thinking of with realtors, but something important to touch on, anything that's a direct expense for what you guys do to earn your income, we want to make sure we're deducting it. So in the next...
So just say I'm going to Florida next week, and what all do I have to do to make it business?
So it would need to have a business purpose. It doesn't have to be 100% business, but you'd want to be able to justify, I went to a conference, or I met with a client, or I was there to view like rental properties that I'm probably going to invest in. You would just need to have some sort of justifiable purpose.
Does it have to be in America or?
No, it can be outside of America. Yeah, it can be anywhere.
She'll decide today she's getting on a plane tomorrow. I've seen her do it.
I think Will had a question.
So to piggyback on that, so let's say you go to Florida, if she were to walk into a local real estate office wherever she's going to learn about the Florida market for educational purposes, that's like one afternoon. Could you consider some of that business?
Yeah,
taking off.
Yeah. So the big thing with that is that gives you the gateway to writing off 100% of the airfare. But hotel and meals and some of those other things, we'd want to only take the ones that are related to the business day. So the day that you potentially do that, we could take that day's hotel cost and that day's meals and things like that. But if you're there for 6 days and the other 5 days, we would want to keep that personal. Yeah.
A real life example. We're all going to Puerto Rico, all three of us together, for 10 days. So if we had a meeting every day.
Team building event of some kind.
Puerto Rico team building. Then we can write the whole thing off.
Yes.
Every day. Oh, we're going to Puerto Rico. Man, that is awesome.
You just want to justify. We did truly have a business purpose. This was a team building event. This was
Every morning I'll have breakfast together.
And write it off.
Yeah.
We'll sit on the beach and talk about business. Okay. Which literally we probably will. We're all going to be working the whole time.
Right. And most of the time you are, because you've got your laptop
With you, you're getting phone calls. So yeah.
I do have a question. So whenever you're in another country, and your fees, your out of the country fees, do you write 100% of that off?
Well, if it's because of a business, purpose, like, hey, yeah, you would. So if it's travel, and we could write off 100% of the fees that are related to airfare or the hotel, but it's just if you're also kind of doing a personal vacation that you can't really justify as business, then we potentially want to allocate some of that as personal and not deductible. Yeah. So. Yeah. Right. Okay, this is a really good topic now about LLCs, S Corps. How should you be set up? So obviously, I don't know how much you guys know about, like if you're set up right now as sole proprietors, DBAs, LLC, S Corp already, but I'm going to kind of assume that no one has much context on this and everyone is just starting from day one. So if you were starting from day one and you became a realtor and somebody sent you a 1099, by default, you don't have any business set up, no entity is created, so you're just what's called a sole proprietor, and you would file, that 1099 you would put on your personal tax return on that Schedule C that I've been mentioning, and you would still be able to take your deductions in the same way we've been talking about, and then whatever your net is, you're going to pay tax on. And whatever that net number is, you're paying self-employment tax, which is the same thing as the Social Security and Medicare, that 15% we've been talking about. So if I get a 1099 for $100,000, I take my mileage, I take my home office, I take my travel, my meals, I whittle that down to a net of $30,000. Well, then that's what I'm paying tax on, is the 30. So I'm paying 15.3% Social Security and Medicare, which is called self-employment tax. So on my tax return, my accountant's filling it out. Oh, you've got to pay, what is that, 7,000 or something in self-employment tax on your 30,000 net income. Plus, your husband works, he has a W-2, so you guys fall into the 22% tax bracket. So you also owe 22% on your 30K. So now I'm paying 22 plus 15. So I'm really paying like 37% on this income, right? So that can add up quickly, as I'm sure you're aware. So that's the way it's set up by default. If you create an LLC let's say if you create an LLC or a DBA for that matter, nothing changes. An LLC is a state entity. It's not an IRS entity. So when you create an LLC, yes, that's great. You've got the liability protection. You've created this entity where you've given yourself more credibility to clients. But it's just a Texas thing, or whatever state you're in. It has the IRS taxes LLCs in a numerous variety of ways. So by default, if you set up your LLC, you're probably setting up a single member LLC. It's just you. So you're going to be taxed as a sole proprietor. You're going to be taxed as what they call a disregarded entity. So nothing changes. It's as though you don't have a business with the IRS. You just continue to file that Schedule C the same way. You continue to take your deductions the same way. Yes, you've maybe set up your LLC bank account. You've got QuickBooks. You've got the LLC, which is great and which we recommend. But from an IRS tax perspective, it actually doesn't really change anything. But it can be the gateway to the S Corp. And actually, sorry, let me rewind before we get there. If you create an LLC that has multi-members, so if you say, hey, I'm a member of this LLC, and my husband's a member of this LLC, and my daughter's a member of this LLC, then by default you're a partnership LLC, and so then the IRS taxes you as a partnership, and so that requires a separate tax return. So you'd file this partnership return, but the tax effect actually is kind of the same exact way as the disregarded entity Schedule C, where on a partnership, you file the partnership return, and then each partner is allocated their share of the net. So the partnership has $100,000 coming in, you've got $50,000 of deductions, so there's $50,000 net income, and you've got two partners. So one partner gets a K1 that says, I earn $25,000, the other gets the K1 that says, I earn $25,000, because they're splitting it 50-50. And then you put that on your personal tax return, so now you've got $25,000, but it's subject to the Social Security and Medicare, that 15% we keep talking about. So basically, the S Corp is the way to save yourself some of this Social Security and Medicare. So creating the LLC provides the liability protection. It doesn't change the way that your self-employment income is taxed, but it can be the first step to the S Corp. So the S Corp, okay, so basically what this allows you to do is the LLC is still the LLC, nothing changes. But you send a letter to the IRS electing to be taxed as an S Corp, and the IRS says, okay, well, you were a disregarded entity or you were a partnership, now we're going to tax you as an S Corp. So now the benefit is you get to split your business's net income into two different buckets. So you split it into kind of like employee bucket and investor bucket. And so by default, when you're self-employed and you're doing the Schedule C or the partnership, all of that net income is though you've been out there earning it like an employee. So all of it is subject to that 15% self-employment tax. When you do the S Corp, what you do is you put yourself as an employee on your own business's payroll. So you actually have to run payroll for yourself, set a reasonable salary. The key is to make it as low as you can. And then that salary is paying the payroll taxes, the Social Security and Medicare. So you're paying the 15.3% on the salary. But everything you earn in addition to your salary, you can just transfer to yourself as distributions, and you get to save 15% because that excess is not subject to the Social Security and Medicare or the self-employment tax. So I know this is a lot of info. One last thing, we always tell people it makes sense to do an S Corp when your net is $50,000 or more. If you're able to write off enough to where your net is $40,000 or $30,000, then doing the Schedule C as a disregarded entity is great, or a sole proprietor, that's great. When you start making $50,000 or more, though, that's where you're going to start to see the tax savings, because the S Corp is a little bit of a headache because you've got to set up payroll, you've got to run payroll for yourself, you've got to get QuickBooks or some type of payroll software. So it adds a little bit of that headache, some extra fees, like if you're paying for, say, QuickBooks payroll, that's like, I think, $50 a month, and then you've got to file 2 tax returns instead of 1. So it adds a little bit of expense. But when you're netting $50,000 or more, you'll start to save and save and save basically as you make more and more money. Any questions on that? It's not even that it's passive. That's a great question. If you're a partnership and you mark it as passive, you're right. You don't pay that self-employment tax. But if you're the one out there doing the work in the partnership, you should be marked as active, which means you should be paying the self-employment tax. Yeah. So the passive thing, like if you're a partnership with your husband, then he's getting a K-1 for half, for example, as passive, so it's not paying the self-employment tax. You're getting a K-1 that's probably active, and you're paying the self-employment tax. That's fine. Depending on how high your income is, the passive partner could be paying what's called net investment income tax, which is like a 4% tax on investment income. Whereas if you did an S Corp and you were the only shareholder and your husband wasn't in it, you could assign all of that income to you. You could set your salary reasonable but low, and then you would only pay the self-employment tax or the Social Security and Medicare on your salary. Everything in addition to that, you could transfer to yourself. That's distributions, and it would be active, but it wouldn't have to pay the self-employment tax or the net investment income tax. So the S Corp's great. I know that's a lot of info, though. Does anyone have any more questions about that?
You said on the LLC, if you have multi-members,
Mm-hmm.
everyone is paying taxes, right? On that.
Well, you're a partnership by default, so each member. So normally, what you do is you file a partnership return, and then each partner, like maybe you have a 50% partner and then a bunch of 10% partners. So if you're whatever that net income is, once you finish the partnership return, that the partnership and even the S Corp returns don't pay tax on the entity level. They file the returns. It's an informational thing, but then they produce these K-1s that go to all the partners or the shareholders. So like if you're the 50% partner, then yes, you would pay tax on your share of your 50% portion of the businesses and net income.
And is that the same as putting them on the board, so if you're on vacation or?
No, that's different. So if they're a partner or a shareholder, that's one thing, and that's where they have to recognize the income. But if you're like, hey, I'm 100% shareholder of my S Corp, but my husband's on my board of directors, that's fine. Technically, if he's on your board, maybe you'd want to pay him some type of little bit of a salary through this, payroll or something like that, or maybe you'd want to give him a 1%. But no, you don't have to. The other thing too is Texas is a common law state, so basically you can create a single member LLC Your husband can be on the board. You can file as either an S Corp or a disregarded entity. But at the end of the day, it all flows through to your joint 1040 tax return. And you know, it works out just fine that way, like where you can do these business meetings like we've talked about, vacation that's actually has a business purpose, and and that sort of thing. Yes.
You've been running it as an LLC for
Hmm.
15 years. How are you?
Oh yeah, it's actually super easy. You can do it at any time. You just send a form in. Yeah, it's like a 2-page form. Um, well, I say super easy. I mean, you might want to have a CPA or someone that knows how to fill it out do it. Yeah, but it's a very quick and easy process. Yeah, we mail the form in. Technically, if you want to be an S Corp for 2025, you're supposed to do so by March 15th. You're supposed to send that form in. But if it's, obviously it's past March 15th, you can retroactively file it. There's just a specific way we have to there's some specific like text we have to fill out on it. But yeah, it's not even too late to do it for this year. So something to think about. It's just, if you do the S Corp, you've got to put yourself on payroll. So that's the big thing. So we've seen some people send in the S Corp and nothing changes. They don't do payroll for themselves. So yeah, they save 15% on their whole business's net income, but technically if they're ever audited or something, that's not the proper way to do it. You're supposed to be paying yourself as an employee and splitting it into those 2 buckets like we talked about. So, all right. And then this third topic is pretty cool, especially for all of you being realtors. We're going to talk about the real estate professional tax status and how you can use this as a benefit to invest in real estate. So by default, when you have rental income or rental loss, it's passive basically. So like, for example, if someone's husband has a W-2 and then the wife has the 1099, and there's a net income on both, right? So like, the husband has 100,000 W-2 income, the wife has 100,000 Schedule C income or income from the S Corp, but then you also have a rental house that has a loss. Well, by default, that loss is passive. So if you don't have passive income, that loss just rolls forward, and it doesn't offset your active income. But there is a tax status where if you're a real estate professional, which all of you would be basically, but the rules would be if you've performed more than 750 hours during the tax year in real estate, basically, which I'm assuming if all of you are realtors, you're spending at least 750 hours a year in real estate, and or more than half of your personal services. So if you don't meet the 750, you could still qualify for real estate professional status if at least 51% of all the work that you're doing is in real estate. So does that make sense? So being a real estate professional is an IRS like classification. It's a box that we check on the tax return that unlocks losses in rental activities to allow you to offset them with active income. So the way this can be great is, and we see this a lot, especially during COVID, like, okay, I make $100,000 on my W-2. My wife is a realtor, and she made $100,000. Okay, so we have $200,000. We're going to pay a ton of tax. But we went to the bank. We got a loan for this house, right? We put $20K down in cash, and we got this rental house. We set it up as a long-term rental. We've got somebody else in there paying it off for us. They're paying us rent. So, I've got this rental income, but then I'm paying, all my fees. Like, I'm paying the bank, my mortgage interest, the property taxes, the homeowner's insurance. We've got all these expenses. So the goal is to kind of break even on a cash flow. So I'm receiving $1,000 a month in rent, and I'm paying about that much in my mortgage and property taxes and all that. So I'm kind of breaking even on a cash flow. But on a tax return, I'm showing a huge loss because I have depreciation. I have my home office deduction. I have mileage. I have my cell phone, my internet, all these things we talked about. So I'm showing a loss, which offsets my W-2, which offsets my real estate Schedule C. So now I'm getting a $20,000 refund, which just paid for this house. That was my down payment. So we saw a lot of that where it's like, basically, I got this investment for free, more or less, not really for free, but I allocated this tax refund to the down payment, and now I've got somebody renting it that's paying it off for me. So as a real estate professional, investing in real estate can be a great, in my opinion, it can be a great strategy, and then you can show a loss on paper, but in reality, you're maybe breaking even, and somebody else is helping you pay for it. So anyway, we see a lot of that with realtors, and so I always like to mention that because you guys are all going to qualify for this real estate professional status, where if you can show the negative on the rental property, then you can offset your other income with that negative. Okay, and so that was actually the end of the presentation. So I'm happy to take more questions. I know that's a lot of info, a lot in different topics and things like that. So yeah, does anyone have any specific questions that we haven't talked about?
Can you go a little bit over that real estate professional status a little bit more?
Yeah.
I'm confused on that, but I don't know what my question is.
Yeah, so
I'll give it, let me try to give it a better example. Okay, so normally income is going to fall into three different buckets. You've got active income, right? So that's like what we've been talking about with that self-employment tax. If I'm getting a W-2, if I'm filing the Schedule C for my realtor business, if I'm an LLC partnership, but I'm the active one, then that's falling into active income. It's subject to that Social Security and Medicare tax. So that's getting taxed the highest. Then there's what's called portfolio income, right? So that might be like long-term capital gains, dividends, things that might get taxed, like money market accounts. So that's going to potentially get taxed at a lower rate, like 15% instead of the highest tax bracket. And also it's now that might be subject to that net investment income tax, which is 4%. So maybe you're paying 20%, but on active income you would have been paying 15 plus 22 or whatever. So that's a lower rate. Then there's passive income, and that'd be like your husband, for example, who's the passive partner in the LLC. He's not the one out there working. He's just like the silent investor. So that income is just taxed at your normal tax brackets, but it's not subject to that 15% self-employment tax. But when you have losses, losses can only sometimes offset certain categories of the income. So like if I have a capital loss of $100,000 because I sold all these stocks that I lost all this money on, I can't offset that negative $100,000 all in 2025 against my W-2. I can only offset up to $3,000 a year, and it just keeps rolling forward until I have capital gains or some to offset it against. So it's the same idea with real estate losses or rental losses. So if I have a rental loss, that's a passive loss. So if I don't have passive income, then that loss doesn't offset anything. It just keeps rolling forward until I eventually have passive income. But when you meet these real estate professional IRS qualifications, they allow you, because you're in the business of real estate, your rental isn't really passive because what you do is real estate. So they let you take that negative and offset your active income with it. So as long as one of you or your husband, for example, is a real estate professional, even if your real estate business broke even, maybe your husband had a $200,000 W-2 and then you had a negative $50,000 on this rental property, that negative 50 could offset your husband's W-2 and you guys could get this huge tax refund to use to reinvest into the rental house or something.
Like you go be rich next year. So say you buy a house and you put $40,000.
Mm-hmm.
How do you mentioned to get that money back?
How do you get it back? That's a great question. Okay, so you put the money down. This is the same principle as we talked about with the vehicles earlier. So if I finance a vehicle even and put $10,000 down, but it's a $60,000 vehicle, that actually doesn't matter. We can write off 100% of that vehicle cost now. Same thing with the house. If I put $40,000 down, but it's a $500,000 house, well, I can start depreciating the full $500,000. Now I don't get to write it all off in 1 year, but I can start depreciating the 500,000 even though I've only put in 40. But then those payments to the bank, your mortgage payments, you don't get to deduct that. You just get to deduct the interest part of that. So you depreciate the cost of the house, the 500,000 over time, and then you write off each year the mortgage interest. But the principal payments that you're paying, that's not deductible because you're depreciating the cost of the house. Now, the way that, especially during COVID, people really got these huge refunds is you can, once you buy this house, by default, you would depreciate it over 27 years. So you pay 500,000, you're getting like 1/27 for the next 27 years. That's not, I mean, it's a good deduction, but it's not going to make a huge difference. So what people would do is in the very first year, and it can even be done in the second, third, or fourth, it can be done at any time, but you do a cost segregation where you say, okay, I paid 500,000, but 100,000 was the framing and the cement and the foundation, and then 200,000 was fixtures, drywall, and we can accelerate the depreciation on the improvements, which is going to be anything drywall in, so like furniture and fixtures, plumbing or like toilets, things like that. We would be able to accelerate that write-off and take it all in that first year and generate this big negative on a tax return. So I know that's a lot of info, but basically you can depreciate the house over time. You can even do the cost segregation analysis where you usually would pay someone to have that done. They come out, they break out your cost into categories, which lets us depreciate certain categories all in 1 year or much faster. And we can show a negative on paper, even though in reality you're cash flowing or you're breaking even. And so then if we can show a negative on paper, we can potentially generate a refund, which kind of helped you with your down payment in a roundabout way.
Yeah.
Does that make sense?
And I kind of think the question of where the 20 grand comes from, but it sounds like you put the money down and then when you file the next year, you get it first.
Yeah. So that is true. You kind of have to up the money at first, and then you hopefully get a refund later on the tax side. Yeah, I mean, you could do a tax planner or something, try to estimate it the best that you can, but you won't have that final information until you file. But yeah, that's a great question. Okay, so it depends if it's so yes, if it's a business investment property, like we're talking about with the rental house. If you like, hey, it's a rental for 5 years. I'm writing it off, I'm depreciating it. Well, if you eventually turn around and sell it, we do have a capital gain. So whatever you sold it for, if you bought it for 500,000 and over the first 5 years you deducted 100,000 of that. So now your cost basis instead of 500,000 is 400,000, and then if you sold it for $1 million, we'd have this capital gain. Now, if you sell your personal residence, so if you've lived there for at least 2 years in the past 5 years, you can exclude up to 250,000 per person, so up to 500,000 for a married couple of the gain on the sale of a personal residence. So.
And on how there is a capital gains tax when you are losing, because right now, well, I don't know about everybody else, but I know a lot of people are losing money in their business right now.
Okay.
So is that going to the $3,000 a year? You can deduct?
So yeah, unfortunately, if it's a personal residence, no, we can't take losses for personal items. Like, if it was your personal house and you sold it at a loss, unfortunately, that's not a deduction. However, if it's an investment property like a rental house or something, and you sell it at a loss, then yes, same principle applies where we can take the capital loss, $3,000 a year, or if you have capital income coming from somewhere else, you could take it more of it in that year. But yeah, unfortunately, personal items, the IRS makes you pay tax on the gain technically, but on the loss, you don't get to deduct it. Yeah. But no, go ahead. Yeah, this is great.
I'm sorry. Okay, I do have a question. Okay, so on whenever you're writing off for marketing versus donations, does it matter one versus the other, or are they about the same?
It does matter. Donations, it's not like a direct deduction as marketing would be. So in other words, when you do your Schedule C that we talked about, for example, you'd have your 1099 at the top and then all those deductions. So marketing, that's going to be that's 100% deduction. It goes, if you had 100,000 on your 1099 and you spent 10,000 on marketing, you get to write off all 10,000 of that, and now you're down to 90, right? With donations, those are part of what's called itemized deductions. And so earlier when we were talking about paying the kids and everyone gets a $15,000 standard, if you're married, that's doubled, so you get 30,000 standard deduction. So by default, if my husband has 100,000 and then I'm the wife, I have 100,000, so we're at 200,000. But then we get a 30,000 standard deduction. So now instead of paying tax on 200,000, we're actually only paying tax on 170. But with donations, you can potentially itemize your deductions if your donations plus your personal mortgage interest plus your property taxes, it's mainly those three things. If those three things add up to more than 30,000, then you could itemize. But if you're just donating a few $1,000s and you're going to be taking the standard deduction, then unfortunately the donations don't actually help you. So yeah, if you can,
So it's better to make it in the advertising or marketing.
Mm-hmm. Yes.
And so like whenever you're adding to like your SEP IRA and your Roth and all those, I know like, is there a way to get the amount you can add to your SEP before you file taxes?
Yes. With the SEP IRA, you can add 25% of your self-employed income. So, so you can contribute up until when you file. So, like for example, if I'm working on my tax return in February, and once I have it pretty much finished, I see, okay, my net income from my self-employment activity was 50,000. Well, then I can say, okay, that means I can contribute 25% of 50,000 to my SEP. So, okay, how much is that? 12.5. So then you put 12.5 in. Before your accountant files the tax return, they add that information there, and you get a deduction for it. Yeah. So you can contribute up until when you file, and then
last year they made me pull out almost everything that I put in because I had so many deductions.
you probably over contributed. Yeah. And so that is, in a sense, it's a good thing because it sounds like you had enough deductions to where you were able to minimize the tax that you paid. But the negative is you can't get as much in the SEP. So, yeah, I'm trying to think if there's anything else I haven't mentioned. It's always great to try to max out either your Roth IRA if you have a Roth IRA. If you make too much money to contribute to a Roth, you can contribute to the traditional, and then you can do what's called a backdoor Roth conversion, where basically you put it in the traditional IRA, you don't get a deduction for it because you make too much money, but then whoever you set that up with can convert it to a Roth. So you can still get your money into those Roth IRAs, which those are good because, yeah, the Roth accounts, you don't get the deduction when you put them in, but they grow, and then when you take it out, it's all that growth is tax free. So the Roth, in my opinion, is better than the traditional, even though now in the traditional, oftentimes you're getting that deduction.
Is there another type of retirement account that we can add?
Well, if you do the S Corp route, and you set up yourself as the employee, on your payroll, you could do a 401k. Now, the thing to pay attention to on that is if you set up a 401k, you have to provide it, you have to offer it to any other full-time employees that you have. But if it's an S Corp and you're the only employee, then you can set that up, and then you can get like up to $70,000 a year into it, because you can contribute as the employee like 20,000, and then the company can match, and their portion ends up being I don't have the exact number in my head, but it's like close to 70,000 that you can get in there per year if you're making that kind of money. So yeah, you can set up, and obviously you can do less, but you could set up a 401k if you're running payroll through an S Corp. If not, maybe you're like, yeah, I'm usually right around 50,000 or less per year. I just want to stay as a single member LLC, Schedule C. Then you can do the SEP, the Roth IRA, the traditional IRA, or SEP. I'm sorry.
Self-employed. What is it?
Pension, self-employed pension, I think.
It's like an IRA that you can put into retirement. I didn't know such thing.
Yeah, it's a great retirement savings strategy. But yeah, those would be the main things that I just wanted to make sure everyone understood is make sure you're keeping up with all the deductions and not missing things, because we see a lot of times that people aren't thinking of the home office or my cell phone bill or paying the kids. So make sure that you're keeping up with that. And then two, make sure you're not paying more than you need to in that self-employment tax. So think about doing an S Corp if your net income from your self-employed activity is $50,000 or more. And then, yeah, three, if you're looking to do more investments, real estate obviously is great in your industry, and you can get some good advantages on a tax perspective from that.
What all services do your company provide?
Yeah, so we offer bookkeeping. So most of what we use is QuickBooks Online. But yeah, we offer bookkeeping services where you could outsource your accounting to us, so we can do all that day-to-day, bookkeeping, reconciling the bank accounts, issuing financial statements monthly or quarterly. We can help with sales tax filings, and then I'm more on the tax side. So like obviously tax planning. Some people like to come in and we could sit down and kind of project, in the summer. Hey, we're halfway through the year. What does this look like if the next half of the year continues kind of the same trajectory? We could see how much tax you might need to pay, or would it make sense to do the S election? So we can do tax planning, and then obviously the tax returns, whether it be your personal, the S Corp return, things like that. So yeah, we kind of do a little bit of it all. So if anyone's interested or needs tax help or bookkeeping help, definitely give us a call. We'd love to help you guys get set up. Yes, we're right by the square, actually, or on the square, or on Walnut Street, almost all the way up to the square. But yeah, right in that area. So probably the easiest way is honestly to either call this number here or email admin@sgwise.com, and we can get you guys set up.